Some people consider insurance to be a necessary evil, but understanding insurance is important. It's one of those things in life that we generally don't think about until we need it. And as you know, insurance is used to protect against the unexpected and pass off to the insurance company that risk in exchange for premiums that you pay every month. In this bonus section, we're going to cover 4 types of insurance risk: life insurance, long-term care, disability, and property and casualty. We're not going to be able to cover health insurance. The Affordable Care Act, sometimes referred to as Obamacare, is complicated and has many moving parts that seem to be added to every day. Please consult with a health insurance specialist if you have questions about your health insurance or your major medical plan. But for life insurance, there are 2 broad categories: term and cash value, of which there's whole life and universal life type policies. Let's go over term first. Most life insurance is used to protect against the unexpected loss of income when someone dies. Because we're generally expected to work for a period of time, usually until age 65, some will buy term insurance to cover the period of their working years. Sometimes parents will cover insurance on themselves that cover the young children until that child reaches college. So just in case something happens to the parent, then the kid will have some money for college, for example. But no matter why you purchase term, all of the policies work about the same way. So what is term insurance? Well, I want you to think about renting a home. When you rent a home, you rent it for a period of time. The home keeps you warm in the winter and cool in the summer and dry when it's raining. When you leave your rental, you turn over the keys to the landlord and you walk away. There's no equity built up during the renting process, and you have only paid the cost of use. So if the air condition breaks, the landlord fixes it. If there's a need for a new roof or a water heater, then the landlord pays for it. You just pay for the rent, and that's it. Well, for term insurance, it's about the same thing. You pay for the mortality cost. That's the cost of dying young during the years that you want covered. And term insurance is usually between 10 to 30 years of time. And after 30 years, then the term is up and the insurance generally ends. There is no equity built up, and you normally just walk away and you hand the keys back to the insurance company, and you no longer have a policy. Premiums are normally lower when you have term, and they do not increase over your time that you have it, even if your health changes. The biggest consideration when purchasing term is to cover the unexpected loss of income that the insured would have brought into the home if the insured died unexpectedly during that period of coverage. So for me, I have term insurance to cover my wife, Robin, should I die early. Of course, I don't want that policy to pay out, right? Because that meant that I died. But if I did, I would want Robin and the kids to be protected. But if I outlive the term, then I'll just walk away from that policy. It did its job, it protected Robin, but now it's over. There is no cash value or equity in the term policy. Because there is no cash value built up, term is the least expensive way to cover my beneficiaries if there's an unexpected and untimely death. And Robin has term insurance on herself. Even during the years when she was not bringing in a salary and was a stay-at-home mom, she provided an economic benefit to me. She was available to put the kids on the school bus, to take the kids to the parent-teachers meetings, take the kids to soccer, and to be with them when they were sick. Of course, we started to homeschool our kids as well, and she was there to help them. All of this and much more allowed me to go to work. If she died unexpectedly, Our plan was for me to care for the kids and to homeschool them and to take them to soccer practice. This might cause me to work half-time or even change jobs to match their school schedule. Life insurance on a stay-at-home mom is often overlooked, and if needed, there becomes a real financial burden on the family. If I didn't want to walk away and have nothing left, and I wanted to accumulate some cash value, I could do that inside of my life insurance. Think about our earlier example of renting a home. Instead of renting, I could buy a home, and I could own it. And with my mortgage payment, we know that part of the mortgage payment goes to the interest, and part of it goes to equity. So after 30 years of a fixed rate mortgage, all of my interest is paid, and I own the home. I own all of the equity. Well, life insurance can be very similar. If I have a cash value policy, part of my payment would go to the cost of mortality. That's the risk of me dying early. But the rest of it would go to a cash value pot inside of the life insurance policy. Just as renting is less expensive, owning a home is more expensive. Well, the same is true with my cash value policy. But it's more expensive because I'm creating a cash value that becomes mine. So after 30 years with the cash value policy, I'll have equity inside of that policy. As I said earlier, most of my insurance is in term, but I have a fair amount that's in cash value as well. Therefore, if I want to take money out of my cash value, I can do that. If I don't die young, and I no longer need insurance to cover my kids or Robin, well, I can cancel that policy in my later years, and all of that cash value built up is mine. I can do whatever I want with it. So as part of a well-rounded insurance plan, if you can afford it, you might want to consider having both term and cash value life insurance policies. And yes, you can have both. And with the above in mind, there's two considerations when thinking about buying life insurance. How much do you need? And how much can you afford? What is the budget available to comfortably pay for these monthly insurance premiums? Well, the lower the amount of the budget available, the higher the term is likely going to be. And if you had an unlimited budget, well, then you would buy all of your insurance in the cash value. Well, for many of us, like me, I don't have an unlimited budget. So a combination of the two works very nicely. Nearly all working individuals have the ability to participate with their company's group life insurance program. These programs can be attractive, as they do not require any medical underwriting to be eligible, just information about someone's age, male or female, and smoking or non-smoking. Generally, there is no blood test and no questions about medicines like cholesterol or high blood pressure, and no questions about pre-existing conditions. This can be a wonderful benefit for someone who has these issues, but becomes a lousy benefit for someone who doesn't. Let me quickly explain. Group life insurance is a certificate program, not a contractual policy. At any time, the employer can decide to eliminate this benefit, can stop making payments, or can even go bankrupt and shutter their doors. The coverage will end without your ability to do anything about it. There is no contract between you and the insurance company. The program is between the insurance company and your employer, not you. Unlike individual insurance that you would get outside of work, that program is binding and is a contract between you and the company and no one else. Also, group insurance loves younger, healthy, non-smoking females. The group hates older, overweight, unhealthy, smoking males. So the younger, healthy females skew the group in favor of the group. The older, unhealthy males skew the group against the group. So unhealthy males and females love the fact that there's no physical underwriting. Why not? because their overall greater risk to the group is subsidized by those who are healthy. The general rule of thumb is this: if you are a female, age 40, and otherwise healthy non-smoker, it becomes quickly better for you to leave the group and get your own policy. The same is true with a male, age 45, who's otherwise healthy and non-smoking. After a female is age 40 and a male is age 45, then they begin to subsidize that overweight, unhealthy smoking male. Why would you ever want to do that? And if that's not enough to convince you to get a policy outside of work, then think of this. Most Americans die due to an illness, not an accident, especially those who are in their working years. So if we die young, it will be due to a cancer or a heart or other illness. And according to the Centers of Disease Control, in 2014, which is when the latest statistics were available, 2.6 million Americans died that year, 2014. Almost half died due to a heart or a cancer disease, 1.3 million. Well, just under 180,000 died due to an accident or suicide. Statistically, very, very low. Now, why is this important to discuss? Because if you're likely to die in your working years, you're likely to die due to an illness. And that illness will become progressively worse, to the point when you're no longer able to work at all. As your health deteriorates, you will one day be alive, but not able to go to work. This will lead to the company laying you off. And when that happens, you're no longer able to contribute to your 401k. You're going to lose your dental and your vision coverage. You'll be able to keep your major medical due to COBRA, but you're going to lose your life insurance. And the group life insurance companies know this, and they're counting on it. Now, don't fault them for it because, they're willing to pay if you do die due to an accident. But they know that statistically, that's unlikely. So here's the good news. Now you know about it too. So do something about it. I believe that you should always have a well thought out life insurance plan outside of the group. You should determine the coverage that you need and the budget you can afford, and then get a binding contract between you and the insurance company outside of work. This way, when you leave that company or that company leaves you, then you maintain your policy. Of course, keep the insurance that you get from the group that's offered for free. Why not? But build your important insurance plan that protects your loved ones and protects your legacy outside of work. Richard was a father of 5 children, all under the age of 15. Richard and his wife wanted a large family, and they were on their way to that goal. But he was diagnosed with colon cancer at 42 and became so sick that after fighting the disease for 6 months, he was unable to continue working. His employer's plan allowed him to purchase 6 times his income through work, and with the one that they had for free, both he and his wife thought this was enough. But when he was no longer employed, he lost his ability to contribute to his 401k, he lost his dental and vision insurance, and he lost his life insurance. Unfortunately, when he died, he had no coverage outside of work. Terry was forced to sell their home. The kids were removed from private school. She had to move in with her parents and had to find a job. This was not the legacy that Richard wanted to leave his family. Almost every single woman that I know is concerned about the possibility of having to go into a nursing home and a further possibility of having to pay for it. As nursing home care becomes more expensive, these women turn to long-term care insurance. Long-term care is becoming more popular as the need is becoming more real. The odds of you needing this type of care are greater than your house burning down or you getting into a major car accident. As a married couple, a husband and a wife make a solemn pledge to care for each other in good times and in bad, in sickness and in health. If he is no longer able to care for you, or if something happens to him, who's going to take care of you? Well, sometimes we can turn to our kids, but they should be raising their families and living their lives. So many women are beginning to turn to long-term care insurance to help fill in the gap. And the benefits are generally computed like this: the number of days that you want to have care for multiplied by the benefit paid for those days. So let's say that you wanted to have care for 3 years and you projected the need for $200 a day. So the math looks like this: 365 days times 3 years times $200 equals $219,000 of benefit available. You'll pay a premium based on your age and health when you purchase the policy. And if you need care and the actual cost per day is below the projected amount, then the amount of money you pull out will be less than what was projected. If a portion of your daily benefit remains unused, you don't lose that money. It remains in the pot for future use, allowing you to stretch more days of coverage. On the other hand, if the cost of care is greater than that daily benefit allowed, in our example was $200, you're only allowed to pull out that contractual daily benefit. You'll have to make up and find from another source the difference. Well, long-term care policies will generally start paying benefits if you're only able to perform 4 out of the 6 daily living functions. And without thinking about it, we all perform 6 daily functions routinely and automatically. However, as we move forward in our life cycle, as we age, these tasks may become challenging. The 6 daily functions are feeding, taking food from a plate and getting it into your mouth without help. But note that someone else can prepare the food. Transferring, the ability to move in and out of a bed or a chair without assistance. But note that the use of a mechanical aid is acceptable. Continence, having complete control over urination and bowel movements. Bathing, the ability to bathe oneself or need help only with one single part of the body, such as the back or a disabled limb. Dressing, the ability to get clothes from a drawer and put them on, including fastening your shirt, your buttons, or your buckles. Note that somebody might be needed to help you tie your shoes. And toileting, going to the toilet and getting on and off of the seat and keeping your genital areas clean and without help. When you apply for a long-term care policy, the insurance company will do a medical evaluation. They are looking for your morbidity risk, not your mortality risk. In general terms, morbidity risk is the likelihood that you're going to get sick and live. Mortality risk is the likelihood that you're going to die. So life insurance is looking for mortality. Long-term care is looking for morbidity. So even if you haven't been able to get a life insurance policy, you may very well qualify and be eligible for a long-term care policy. There are also many additional benefits that you'll need to consider when purchasing a long-term care policy. Is there a daily benefit inflation protection? Do you have longevity in your family? How long should you have coverage for? Because some policies will pay benefits for life. Does the policy cover you if you are in a facility, or cover you if you want to stay at home and have care at home? And of course, which carrier to go with, and what is their strength and their claims paying history? Disability insurance is often overlooked when considering a well thought out insurance plan. No one expects to become disabled, yet the statistics tell us that the likelihood of dying during our working years is much lower than the likelihood of you becoming disabled. Let me give you a powerful analogy. Let's say that you had a black box and you put that black box on your couch in your living room, and you notice that this black box has an electrical cord, so you connect it to the plug in the wall. Within moments, out pops a crisp $100 bill. You know it came from the box, but you're not sure how it did. And then a minute or so later, boom, out pops another $100 bill. And like magic, every now and again, another $100 bill pops out, and then another, out of nowhere. Well, before too long, you have a nice pile of crisp $100 legal tender bills. Would you do anything special with that black box? Would you insure that box against a fire or theft or even a mechanical breakdown? I know I would. I would even insure the power source on the wall. Well, if you haven't figured it out, that black box represents the breadwinner in your home, sitting right there on the couch, depositing $100 bills into your bank account. Would you insure that breadwinner? Many insure the power source through life insurance, but most do not insure a mechanical failure. That would be disability insurance. So much like long-term care insurance, when you purchase disability insurance, you purchase a certain amount of daily benefit over a period of time. After an elimination period, usually about 90 days or so, if the disability continues, the policy will begin to pay benefits for as long as the period of disability continues and the period of time you purchased it. And if you have an unlimited policy, that payment will continue until the person turns 65. Disability is used and designed to replace income during our working years, and 65 is commonly the age of retirement. One of the biggest concerns when the breadwinner becomes disabled is that the income will shrink, but the expenses will mount. And as the income declines and expenses grow for the care of nurses, etc., well, then that space that falls in between is debt. This may seem unkind, but if the person died, then life insurance would pay out, and there would be no ongoing medical expenses. But if the person became disabled, then those medical expenses will mount and likely wipe out all your savings. Without really thinking about it, we all have a black box sitting right there on the couch. Maybe it's time to consider insuring that box. Well, most, if not all, states require vehicles on the road to have liability insurance at some basic level. And if you have a mortgage on your home, your bank will require you to have homeowners insurance as well. Therefore, let's spend a couple of minutes talking about both. When you purchase auto insurance, you purchase liability for the other person in the other car just in case there's an accident and it's your fault and the other person is injured. When you pull out your policy, you'll notice something like this: bodily injury, liability coverage is $100,000, $300,000. Property coverage, $50,000. Uninsured and underinsured motorist, $100,000, $300,000, and uninsured property coverage, $50,000. Well, do you know what those numbers represent? Well, in a short couple of minutes, you'll be able to answer to this question, yes. Well, if you're at fault and you're in an accident and you injure the other person or kill the other person in the other car, then their family is going to do the great American thing. They're going to sue you. And if your coverage is the numbers above, then your insurance company will pay up to $100,000 per person in the other car, but no more than $300,000 per accident. Additionally, your insurance company will pay up to $50,000 to repair property that was damaged to the other vehicle or whatever you hit, like a fire hydrant or the side of a building. If you're injured by a driver who hit you and it was their fault, but they had no insurance or less insurance than you do, and you're injured or killed, then your family's going to do the great American thing and sue them. Well, if they have no insurance, then they're likely to not be able to pay a court judgment either. So you'll go to your insurance policy and you'll get $100,000 per person in your vehicle, but no more than $300,000 per accident. Also, you'll have $50,000 to cover the damage that's occurred to your property. Many will carry additional insurance beyond liability that will pay for repairs to your car if the accident was your fault. And that's collision and comprehensive coverage, which works like this. If you're in an accident and it's your fault and your car is damaged, you will likely file a claim. Whatever your collision deductible is, you would pay that, and then the balance of the value of the repair would be covered by the insurance company, up to the total value of the vehicle. If the cost to repair the damage exceeded the value of the vehicle, well, that's when the insurance company would total your vehicle and pay you what it's worth, minus the deductible. But if your vehicle is damaged because the wind blew the tree and the tree fell on your vehicle, then that would be comprehensive coverage. If your vehicle was damaged by an act of God, lightning or hail, for example, then that is also comprehensive. One of the most common comprehensive claims is when you're driving on the interstate besides an 18-wheeler and it throws a rock and crashed your windshield. You didn't hit the rock hit you. Well, you would pay the deductible and the insurance company would pay the rest. Generally, the above is what most owners have, but there's other protections as well, including new car replacement, roadside assistance that covers towing, fixing a flat, opening a locked door when your keys are on the inside, bring you gas, and jumping a dead battery. And rental reimbursement is also available if your car is in the shop for a covered repair. Well, your home should be insured against fire and theft up to the value of the dwelling. This is not the amount that you would sell your home for, as that includes the value of the land and the goodwill of location. But the dwelling value is the amount that it would cost if your home burns to the ground and you had to rebuild it. The home policies also protect the personal property that you have anywhere in the world. So if your luggage is stolen in the airport or that favorite vacation destination, then your homeowner's policy will cover this theft. Additionally, you'll want to have liability protection for those who don't live in your home. If a guest is injured due to your negligence, then the liability portion of your homeowner's policy will cover their injury. It seems like every year in Northern Virginia, we hear about a deck that collapses during Christmas or 4th of July. And those injuries that occur are covered under the liability portion of your homeowner's policy. High-value jewelry, watches, and furs, along with other items like silverware, firearms, musical equipment, stamp and coin collections, paintings and art, and cameras, will need particular coverage. If you own these items, then you're going to want to consult with your agent to make sure that you're properly protected. Most homeowners' policies have low coverage for these items, so if you have them, you're going to want to add additional coverage by purchasing additional protection. Some closing considerations about insurance in general. Well, research the quality of the company that you buy any policy from. Many independent companies rate insurance companies. I would absolutely go with at least an A-rated company or better. And make certain that you look at not only this year's ratings, but get a track record. Many quality companies are AAA rated. And after the recent credit quality issues of a couple years ago, you should go with a strong company, even if there's a slightly higher premium. Obviously, it would do you no good if you make a claim to a company that cannot pay it. There's a lot of things to think about when regarding insurance. It may seem like a necessary evil, but you absolutely want it there when you file a claim. This is all part of your legacy, a legacy of a well thought out plan, and insurance is part of it.